Hello guys, welcome to Go Capital. Today we'll be going into the second part of the strategy I called a price pathway. But before we go into that, I want to appeal to you to help do something. It takes a lot of effort, a lot of resources, a lot of time, and what have you. A lot of things are put into place to ensure that I'm able to make these videos that you see. Actually, this is something that came as a result of a request by some persons. I really didn't have that intention that one day I will have a YouTube channel that I will start to teach people about Forex. But when a lot of persons around me who have seen me trade, and those who have been asking me what do I do for a living, and they are interested to learn what I do, there are many, and because of that I decided that I would take them all at once on a YouTube course. That is what started this channel. I have taught a lot of persons on individual basis before, but this time around it came together, a lot of them at once. So I just felt the only way to carry them along is to do something that is going to be accessible generally to them. I normally do one-on-one coaching. That is the best I've seen. So what I'm trying to appeal to you is I'm appealing that you should please subscribe to this channel, because I'm not charging money for what I'm doing now. This is what I do for a living. I mean, trading. That's what I do for a living. I make money via trading. So, and it is something that takes time from me. This video I'm making takes time away from me. It takes resources, takes money, takes all kinds of things to make a video like this. And I really want you to subscribe to the channel, as that is the only way you can pay me back for what I'm giving out. I'm not charging you money, and this is what I'm using to trade. I want to teach you for free. I've taught people support and resistance. They're using it to make money, but that's not what I'm here to teach you. I've taught people Fibonacci, and they're using that alone to make money, but that's not what I want to teach you. I've taught people supply and demand, and they're using that to make money, but that's not what I want to teach you. I've taught people order blocks, mitigation blocks, and the rest. What I want to teach you in this course is something that I am using, not what I know is working, but what I am using. There's difference in that. The difference in what I'm saying. If I say this is what is working, is different from what I'm using. I can teach you a lot of things that works. Do you understand? There are a lot of things that work. I've tested quite a lot of things. It's not like they don't work, they work. But there's something I use to trade that gives me the confidence to take at least 300 pips weekly from the market. Actually, that is after your minus losses, because I take losses as well. There's nobody who don't take losses. So, but if at the end of taking losses in the week, you can still come out with 300 to 500 pips, then it is something I think I should use and forget every other thing, because I've never used a strategy that gave me up to that. This strategy I'm about to teach you has the potential of giving you 1:3, 1:4, 1:5 comfortably of you. I mean, when you are risking 1% of your account, for example, this strategy has it can give you 3 arrow, can give you 4 arrow, can give you 5 arrow. The highest I've taken with this strategy is 1:11. I have only taken that one once anyway. So I've entered the trade with this strategy that gave me 1:11. Let me explain what that means. If I am taking $1 risk, for example, I made $11 profit. So if I'm risking $1,000, it means I made $11,000. But I didn't risk $1,000 because I don't have such an account to risk $1,000 at the moment. So I must be frank with you. But the strategy has given me 1:11, 1:10 a lot of times, 1:11 only once, 1:5 uncountable. I can't count. So the thing is, the strategy, sometimes I risk, just depending on the structure, depending on what I'm going, depending on what the market shows you, sometimes I risk only 10 pips, sometimes 20 pips, sometimes 70 pips. So, and at the end of the day, I can take 1:3, 1:4, 1:5, 1:2, very common. In fact, I'm not even saying you use this strategy for 1:2 because it will give you 1:2 once you analyze correctly. I'm not saying you will not make losses, but I have used it and it can give me guaranteed over 200 pips to 300 pips weekly minus losses, like plus and minus losses. Are you with me now? So I take 100 pips a lot, 200 pips a lot. Those are very, very, very common pips. Do you understand me? 300 pips a lot. But the thing is, it's not really about the number of pips. It's about the size of the trade. It's about what you are risking and what you are gaining. And the strategy is something that is going to help you. So, and I'm giving it all out for free. So the only thing I'm asking you to do for me in return is please subscribe to this channel. Subscribe and like the video. It's a new channel. It's still very young. If you watch some of the videos, you will see that the views are very small. So because it's a new channel, you understand? So support the channel and help other traders like you as well, who don't even know how to start. If you notice, I'm taking some kind of topics that are really basic, like really basic. So because there are people who I'm taking from scratch, you understand? So I want you to, encourage the channel by subscribing. Encourage me. At the same time as you subscribe, you encourage me and you make the channel to grow as well. So then the next thing I want to say is this particular topic of today we're going to be dealing with is just a part of the strategy. We've done the first part of the strategy in the previous video. So if you have not watched the previous video, I will advise that you watch that one first before you come to this one. So, and I will not just also rush into the strategy because there are some persons who are new to trading. So I'll just go slow. But believe you me, I won't do a lot of unnecessary things. I will just say the things that are particular to the strategy, and those things are going to be part of the topic of today. So with that said and done, let's get to class. Welcome once again. Okay, so I want to be talking about technical analysis today. Technical analysis, and I think I should share my whiteboard. Let me share my whiteboard. So I'll be talking about technical analysis. That's what we'll be doing today. Now, technical analysis is simply analyzing your charts. The forex market is represented graphically in what we call a forex chart, and the forex charts are shown to us by various platforms. I told you guys in the basic course that we use MetaTrader 4 or MetaTrader 5 or TradingView, so to analyze the forex market, because whatever is going on in the forex market in terms of buying and selling of currencies is represented in a chart. So that chart is called a Forex chart. Are you with me now? So the Forex chart is what I showed you previously. That let me show it to you again. I don't know whether, okay, let me just show it to you. So this is an example of a chart. So these are this is the price of euro versus JPY represented in chart. Do you understand? So what we'll be doing is how you will understand to read this kind of a thing to make money from it. So you will not read this in isolation. You will add it to what I've done in previous class, and I'll do everything. It will be clear for you. Okay, so just don't panic at this level yet. All right. Okay, so technical analysis will be what we'll be looking at. Looking at technical analysis. So like I said, we'll be looking at technical analysis, and the analysis is about a chart, about a Forex chart. What do we see on the Forex chart that we are going to be analyzing? You know, every businessman, before he goes into business, he does what we call a feasibility study, and that feasibility study is to study the area is going to situate his business, the location. He will study quite a number of things. He will study the strengths, the weaknesses, the opportunities, and the threats that faces that business in that area. And he will do quite a number of things. He will write budget, a business plan, and all kinds of things. They are all part of the feasibility study. So when a businessman or an entrepreneur finish doing all of his due diligence, in this case now feasibility study, then he launches that business in line with what is written down already. So as a trader in the Forex market, there is what we call Forex analysis. You analyze the Forex market, and then you see the opportunities, the weakness, the threats, and the strength of the particular asset you want to trade, and then you exploit the opportunities. Are you getting me? So that's what you do. All of this is called analysis. Now, in the fundamental analysis, I told you about some kind of places where you look at what is going on in the economies of the currencies you are interested in trading. So once you have done your feasibility study, once you have done your due diligence, that means you've done your fundamental analysis, you have gotten to that part where you know what the economy of the country you are looking at is doing versus another economy. You already have an idea of where there is strength and where there is weakness. Are you getting me? So you now come to your technical analysis to do further analysis in the direction of what the result of the previous analysis gave to you. So one of the things we use in technical analysis, according to the chart I just showed you, is what we call candlesticks. The chart I showed you before is the candlestick chart, Japanese candlestick chart. There are different kinds of charts. Let me go back to the chart so that I can show to you. You can be taking notes, you can write it down, because I may not need to be writing it on the whiteboard. Okay, so this is Japanese candlestick chart. You can go and study the history behind Japanese candlestick chart. We are not here for all of that history. So if I come here, I can change it to a different kind of chart. If I click on this place now, I will see that there's what we call a bar chart. This is bars. If I click on it, this chart will change to bars. This is bar chart. Okay, then if I click on it, I see hollow candles. This is a hollow candle chart. Then these columns, this is a kind of chart as well. People use this to trade, just that, you know, some of us are not good at using this to trade. Then this is what we call a line chart. A line chart, you understand? So then this is an area chart. Is a kind of chart as well. Then this is a baseline chart. This is a Kinachi chart. This chart is a different kind of chart called a Kinachi chart. Then these are Renko charts. Really though, these are Renko, but I don't know how. Okay, let me see if I can. Right. These are Renko charts. Okay, so these are Renko charts, and there was a time I was using this chart to trade because I understand it. You understand? I know how to use this chart to trade, but I don't use it anymore because the strategy I'm currently using is not built upon it. There was a time I have a strategy that is completely built on this type of chart. Do you understand me? So, but in my years of trading, I've moved on and on and on and on, and I've got up to other levels where I don't really use this type of chart any longer. Okay, so now there are many other types. So, but let's go back to the candles, the Japanese candlestick chart. Okay, so this is the Japanese candlestick chart. This is the most common chart people use to trade everywhere. So what we'll be doing in this course is learning how to use this chart. What I will teach you is going to be something you can use to trade any time of the day. It doesn't really matter the Forex session. I trade in the night, I trade in the day, I trade any time of the day. So because I trade on what you call a 4-hour candlestick chart, you will understand what all of that is as I continue. So now this kind of chart needs to be understood. If you see it very proper, if you look at it very properly, you will see there are candles that are green and you see others that are red. Now for the candlestick charts, the candles that are green are the candles that forms when market is going up, when the price of that particular currency is going up. For example, the Euro JPY that we're looking at, which is the Euro versus Japanese yen. This kind of charts is the same for every chart anyway. The green one implies that the Euro is stronger than the JPY, so market will be going up. Are you getting me? So then whenever the Japanese yen becomes stronger than the Euro, that means market will be selling, so the Euro will be strong. Sorry, the JPY will be strong. When JPY is strong, the chart will create a red candle. Are you with me? So the ones that are going up, which are the green candles, are called the bullish candlesticks. Bullish. They are the buying, bullish. So I don't know. I think I can write. Yeah, I can write. Let me use the word bullish. Yes, bullish. So the candles that are going up are the bullish candles. Are you with me? So while the ones that are going down are called bearish. Bearish. Are called bearish. I don't know how I can. Right, bearish. The ones that are going down, let me change the color to red so that it will match. All right, so the ones that are going down like this type are called bearish candles. Are you with me now? So for a bullish candle, the market will have what we call an open price and a low, a high, and a close. Now let me zoom this very well. Let me zoom. Let's use this particular candle that's here for explanation. The market opened at this part. Are you seeing where the hand is? Here the cross is. This is where the market opened. Then at a point in this particular time frame, price came down and went back up again and kept going up. This particular part here is called the low. The low. Are you with me? So that's the lowest price. The market continued going up and came to a high and also closed at the high. So for this candle, the close is the same thing as the high. So in a candlestick chart, we have low, open, low, high, close. Are you getting me? Open, low, high, close. Now for this other second bullish candle that is close to it, you will see that market opened here. Market will always open for a new candle where the previous one closed. Are you with me? So market opened here for the new candle just at the same point where the previous candle closed. So the close of the previous candle will become the open of the new candle. So market opened at this point, and just in that same time frame, it moved down a bit and also came back up and got to a high at this place, at this point, then came down to close here. Are you with me? So that is what a bullish candle does. For a bullish candle, the open price will always be below. It will always be below the close. Are you getting me? This is the close for this candle. This is the close. So the open will always be below the close. That's for a bullish candle. Okay. Now, just a part of the whole thing I want to mention is that this is a 4-hour candlestick chart. 4 hour meaning this, but any candle you are looking at here now, it takes 4 hours for it to open and close. So from the time this candle opened and closed is 4 hours. So every candle in this chart is 4 hours. If I switch to a 1 minute time frame, it will mean that every candle is 1 minute. If I switch to a 2 minutes time frame, it will mean that every candle is 2 minutes. If I switch to a 1 hour candlestick chart, a 1 hour time frame, it means that every candle in that time frame is 1 hour. Are you with me? So that's what it means. Now, for this candle now, we're on the H4, we're on the 4 hour time frame. It means it took 4 hours for this full candle you are seeing here now to form. Even all these small ones, it took 4 hours for them to become like this. Are you with me? So all of them is for 4 hours. Each of these candles are for 4 hours. Now for this red one, let's use this as an example. It opened here. This was the open price. At a point in this particular candle, this time frame, market went up to this level and came down again, came down to this level. Are you seeing it? And then closed here. Now this is a bearish candle. In this case, this bearish candle is giving us information that the open price is always above the close. So for a bearish candle, you can write this down: the open price will always be above the close. Are you with me? So, but this is also the high, this is also the low. For a bullish candle, this is also the high, this is the low. A low is a low, a high is a high. Okay. So, but the close and the open are not the same for the bearish and the bullish. The case of the bullish, the open is below, while the case of the bearish, the open is above. Are you with me now? So because this candle is going down, that's why it is red. I hope you understand this concept. So if you understand this concept, then I will just show you the next thing that is important in this strategy. This is where we start looking at the strategy properly now. So I will show you four kinds of candlesticks that are important for this strategy. They are not the strategy, but they are important for the strategy. We're going to look at what we call a bullish engulfing pattern, a bullish engulfing pattern, and then also a bearish engulfing pattern. We'll look at them now. Bearish engulfing, bullish engulfing. So the word bullish is the same word, the word bearish is the same word as this. So for a bullish engulfing, it actually represents, it talks about a kind of a candlestick chart, a candlestick pattern that has one candle engulfing the other, one candle engulfing the other. So I want to look for an example of such and show to you. This is an example of it. This is an example of it. This particular type of candle, these two candles stick together, form what we call the engulfing candlesticks. Now the bullish candle is half or smaller than the bearish candle that is next to it. This type of pattern is called a bearish engulfing. I think I will have to go to the whiteboard very soon to show to you there, but let me how do I highlight it for you now? So I want to highlight the okay. All right, so this pattern you are seeing here in that box, this green and the red together is what you call a bearish engulfing. Okay, look at it here as well. It's almost everywhere on the chart, so you need that kind of chart as part of what I'm talking about. Then when you see a bearish candle and a bullish one together like this is the case for a bullish engulfing. That's the case for a bullish engulfing. So this, I don't know whether you can see what I'm doing. What I'm trying to do is this red and this green together is a bullish engulfing. So when the red is smaller than the green, so remember that for this one the red is at the left, the green is at the right, while for this one the red is at the right. Are you with me now? So just take note of the opposite net of it. This is red before green, this is green before red. So when you see a bullish candle like this small and a long bearish one like this that is engulfing the bullish one, it is called a bearish engulfing. So when you see a small bearish candle like this and a long bullish one engulfing it, it is called a bullish engulfing. Okay, so those are very important kind of candlesticks I want to show to you. Then this is the other type I want to show to you. This is very important. This type is what we call a tweezer bottom. This type is what we call a tweezer bottom. So when the red and the green are equal, they are the same size, you call it a tweezer bottom. Well, if it appears at the top, it is called a tweezer top. I don't know if I can get anyone here now. I'm looking for, just hold on. This is a 4-hour chart, so the patterns may not be many, but on a smaller time frame there will be many. Let me switch to a smaller time frame so that we can have many of these kind of patterns. Let me switch to the 1-hour time frame. So okay, so you see this type, this is one I showed you before. This is a tweezer bottom. Let me write it out for you. Tweezer bottom. Okay, all right, so this is the tweezer bottom, and I hope you are seeing it clearly. I hope you are seeing it clearly. Yeah, a tweezer bottom, that's the way it looks like. You will see the red and the green the same size. So then a tweezer top, it will still be the same thing, but it will be at the top. To be at the top. Looking for, yeah, there's one here, tweezer top. So tweezer top. You'll hardly find it in an uptrend. You don't easily get it in an uptrend, but the tweezer bottom is always present in an uptrend. So don't worry, you understand what all of that is very, very soon. So this market is an uptrending market. That's why we're not finding it so easy. Okay, this is an example of it here. So an example of it here. So let me mark it out for you. A tweezer top is a tweezer top. Are you seeing it? Is a tweezer top. So we need this type of candlesticks for us to trade this strategy. Then I've mentioned engulfing and tweezer. For the engulfing we have bearish engulfing and bullish engulfing, while for the tweezer we have tweezer top and tweezer bottom. Then the last candlestick chart type that I want to show to you, the kind of candles grouping that you will see together, is what we call a hammer and an inverted hammer. So for the hammer appears at the bottom, while the inverted hammer appears at the top. So this is a hammer. This is a type of a hammer. This one. This is a hammer. When you see a bullish candle like this, but with a very long wick, this part of the candles is called a wick. This part is called a wick. This long part is called a wick. So when you see it has small body at the top, but a very long wick at the bottom, that's a hammer. You see, it's very good. It's important for the strategy we want to look at. Very, very important. Okay. Then if you see it at the top, then it is called an inverted hammer. An inverted hammer. Okay. This is it here. An inverted hammer. The color of the candle does not matter. The color of the wick does not matter, as long as the wick is very long. Look at it here also. It's an inverted hammer. Are you seeing it? So, but the one that's at the bottom is called a hammer. So what have I talked about that we're going to be looking at? Let me go back and show to you. So I've said I'll be looking at one of the things. One, bullish engulfing. Number two, bearish engulfing. Then number three, looking at tweezer top. Number four, tweezer bottom. Then number five, we're looking at hammer. Number six, we'll be looking at inverted hammer. So these are the 6 important candlestick charts that we will be using as part of the strategy. This is not the strategy, this is as part of the technical analysis. Okay, so I actually don't use them because it's like it's my brain already. I know the charts, so I don't need bullish engulfing, bearish engulfing, tweezer top to trade. But it will help beginners like you to understand where to look at in the chart for you to do the things I want to show to you later. Okay, so this is not support and resistance, this is not trend line, this is not supply and demand. This is something really basic, and we give you 300 pips weekly if you understand how to use it. Okay, so then okay, these are important part of the charts that you must take note of. I've written them out for you if you could not write them out at that time, but you know they are the patterns already from the chart. I showed them to you on the chart. So then the next thing I'm going to show to you as part of this is what we call trends. Okay, trends. What did I say? Trends. So let me wipe this board now. I hope you have taken note of this or you have screenshotted it. Okay, so the next thing we'll be looking at is trends. Like I said before, this strategy is actually called trends. That's the strategy. It's price pathway. Price moves in trends. Price moves in a particular way. It has a behavior when it's moving. Whether it is going up, whether it is going down, it has a behavior. So now, when market has a behavior, a particular way it behaves, a style of behavior, you call it a trend. Okay, you call it a trend. So, and in the forex market, we have 2 types of trends majorly. We have uptrend, and then we have downtrend. Are you getting me? So we have uptrend and we have downtrend in the forex market. two types of trend majorly. So ability to understand these two things is key, is important. An uptrend is when the price of the market is going up, while the downtrend is vice versa, is the opposite. Okay, so when you say downtrend, it means market is going down. Are you with me? So then the forex market moves like this. For an uptrend, it will move from a particular low to a high, and then it will come down. It will come down small, and then it will go up again. Let me use the chart, please. Sorry, let me use the chart. Use the chart to draw it for you. All right, for an uptrend, market will move from a low to a top to a high, and then it will come down a bit and then go up again, then come down a bit, go up again. Now this type of thing is called an uptrend. Okay, it's called what? An uptrend. So in the forex market, you will see this type of thing happen. Then the opposite is going to be a downtrend. Market will move from a high please excuse me. Market will move from a high to a low, and then go up again to a high, and come down to a low, and go up again to a high, and come down to a low. Okay, that's the way the forex market moves. This is a case of a downtrend. Okay, so that's the scenario of a downtrend. Now for the uptrend, this particular part of the chart is called a low, represented by L. So this is a low. Okay, so then this is a high. This is a high. Now this particular part is called a higher low. The low is higher than the previous one, so it's called a higher low. Okay, then this particular part that you see here is called a higher high. Higher high. Okay, when I say higher high, then this part is the same with this. It's also called a higher low. So for an uptrend, you have a series of higher highs and higher lows. What did I say? A series of higher highs and higher lows. A series of higher highs and higher lows. A low, high, higher low, higher high, higher low, higher high. This is the way an uptrend moves. Okay, do you understand? All right, now for a downtrend, it moves from a high. Then it comes to a low. Okay, so this is a low in the market, and then it goes back to a lower high, but this high is lower than the previous high, so it comes to a lower high. Okay, so then it goes down again to a lower low. This is what you call a lower low, because it's lower than the previous low. Are you with me? So then it goes back up again to a lower high, and it continues like that, a lower high. Okay, a lower high, and then goes back down to a lower low. All right, a lower low. So this is how the forex market moves. For an uptrend, it moves from a low to a high, then it retraces. This part is called a retracement. What did I say? A retracement or a pullback. So it retraces. This part is called an impulse move. This long part is called an impulse move. And this part is a retracement. Let me write it. So this is called an impulse or a rally. It can be an impulse or a rally up. Do you understand? So why this part is called a retracement or a pullback. A retracement or what? A pullback. Retracement or a pullback. Okay, pullback or a retracement. That's what this part is called. This part that comes down. All right. So and it continues. So in an uptrend, you have an impulse toward the upside, a retracement downward, an impulse upwards again to a higher high, retracement downward, an impulse upwards, and it continues like that. Okay. So then for a downtrend, reverse is the case. You have an impulse down like this, a rally down, a drop, and then a retracement again, a drop, a retracement, a drop, a retracement, and the cycles continue. Okay, so that is how the forex market moves. Are you with me? That's the two trends that occur in the forex market. There's another kind of trend that is called the sideways trend. So the sideways trend moves like this from a low to a high, comes back to the same point, and then goes back to the same point up, the same point down, the same point up. So it's neither going up nor down. It's just in a range. Okay, it's just what? In a range. So we call this a sideways trend. All of these highs will be equal. So you have high, low, low. There's no lower high and lower low here in this case. Okay, so you just have a high, low, low. That's the case for a sideways trend. Are you with me? You get what I said? So this will be a high. Yeah, that will be a high. Then the same thing with this, that will be a high as well. And then with this, that will be a high, but this will be a low. You get? This will be a low, and then here also to be a low, and the thing continues. Here will also be a low as well. Okay, it will also be a low. So that's what you see for a market that is on a sideways trend. All right, so how do you use all this kind of the way this particular the strategy I want to teach you here, what I'm about to teach you is not going to be more than this. We're not going to go beyond this point to be talking about big things that people talk about in the forex market. Is this particular movement I want to teach you. I want to teach you how you can trade with this movement up and down. That means the trend itself, this uptrend, how do you trade the uptrend? Then the downtrend, how do you trade the downtrend? Then this particular sideways, how do you use it to trade? Now I don't trade sideways, but I use it as part of what I used to trade. What I mean is, it is part of what makes me to understand my trend, the trend of the market. But I don't trade the sideways movement, but I use it to know what to do when this starts and when this starts. Okay, so if this is starting, it's going to start from this one. If this is starting, it's going to start from this one. That's where the first market moves. If this market is going to go up, it will go up from a range. If this market wants to go down, it will go down from a range. That's the way it is. Okay, so your own is, how do you know how to position yourself to trade this one up and then trade this one down starting from here? That's what I want to teach you. Okay, but there are other things that I'm going to come into it. So as part of the technical analysis video, I will be doing another video. So this one I will likely stop this class here so that you can go and reflect and think about what I've said so far. I've mentioned candlesticks, the types of candlesticks that are important, which is the bullish engulfing and bearish engulfing. I've mentioned the inverted hammer and the hammer. I've mentioned tweezer tops and tweezer bottom. Then that's the only candlestick patterns you need, those 6. There are 3 actually, just that one is bullish, one is bearish. So you have 6. There are 3, but you have the bearish one and the bullish one. So, and then trend, impulse, retracement, impulse, retracement, impulse. Then you have for a downtrend, a drop, retracement, drop, retracement, drop. Okay, now for a sideways trend, you have an impulse again, an impulse. It's an equal movement. It's not really showing you higher highs or higher lows in the case of an uptrend. So this is an uptrend. An uptrend gives you higher highs, higher lows. Then a downtrend gives you lower highs, lower lows. Okay, lower highs, lower lows. That's the structure of a downtrend. So now let's look at the chart to see whether we're going to spot this. Now let's look at the chart. You see rightly that the market, sorry, I don't need this, let me delete it. All right, now this particular market, this part of the market is called a downtrend. This part is a downtrend. This is 4 hour candlestick, so this is a whole lot of weeks. These are about 3 weeks that's here. Now the market began from here and came down to a point like this, to a low, and went back to a high that is lower than the previous one, which that is lower than this one. Then it comes down again to a low that is lower than this one, okay, and went back up to a high that is lower than this one. So that's a lower high, and came back again to a low that is lower than this one, then to a high that is lower than this one, and the circle continues like this until it changed. Now I'm going to explain to you how to use the strategy just by doing this thing I've said now. This is structure of a downtrend, okay? Structure of a downtrend. All right, then something happened when it got here. I will show you what happened in the next video. I will show you why this market changed to an uptrend and how you will know that the trend have changed, so that you will not start joining the trend. I will show you all of that next week in the next video, okay? So, but you must know that market moves like this. It moves down and goes up and comes down and goes up, comes down, goes up, comes down. That's the way the market moves. So this is structure of a downtrend. In this case, this is a high, this is a low, this is a lower high, this is a lower low, this is a lower high, lower low, lower high, lower low, lower high, lower low, until something happened here. What happened here is what changed it from the structure of a downtrend. So once the structure changes from, let me just tell you now, once the structure changes from lower high, lower low, and then the highs now became equal or went above it, then anticipate that the structure is about to change to an uptrend. Okay, are you with me? Anticipate that the structure is about to change to an uptrend. Once you see that the structure of lower lows, lower highs is over, that means this particular high is no longer lower than this one but higher. Actually, you can see it here that it is higher. Trying to see how I can move it. I don't know what I'm supposed to do. Okay, let's just stop it here instead. All right, so if you look at it here, this particular high became equal. Immediately it became equal, something happened. The trend changed from a downtrend and started going back up for an uptrend. Immediately you spot something like this, just know that the trend is about to change. What I'm telling you now is what I used to trade, and this is how I take 100 pips on a trade, 200 pips on a trade, 300 cumulative plus and minus losses, 300 pips every week, plus and minus losses. And sometimes I don't trade more than twice a week. Sometimes I only enter 2 trades in a week because I trade on the 4-hour time frame. Okay, I'm not the type that trade on the 5 minutes, 10 minutes. No, I'm not like that. It's too busy for me. I'm too busy. I go to work, you understand? I go to work from morning to evening. So I take my trades at work sometimes in the night. So the 4-hour time frame gives me enough room to trade without being busy. Okay, even though I'm working, but I'm not missing the trades because it's on the 4-hour time frame. So immediately the market began from there. What did you see? Started going up. It got to a high, came down. Oh God, how do I adjust this chart now? I can't see this chart. Sorry, let me just see how I can bring it down. Okay. So this is the structure I'm talking about. You can see that immediately the high here changed. There was a temporary downtrend here, or a range. So immediately the highs became equal. The uptrend was paused for some time. Then before it now started coming down again. Okay, coming down from that point to this point, then to this point, to this point, to this point. So this was pause. On the smaller time frame, these are major moves, but this is a bigger time frame like the 4-hour. This is a whole week you are seeing here. This is a whole 1 week you are seeing here. Immediately the structure got violated here again. That means this high became higher than this one. The structure changed to an uptrend again. Are you getting it? Are you getting it? Are you getting it? So that's how I'm going to show you that this is real, that this works, and this is happening every time in the forex market. So next week I will be more detailed. I'll be more detailed because I just use this now as a way to help those who are just learning to understand what a candlestick chart is and what an uptrend and a downtrend is. So next week I'll be going to the strategy properly with accurate points of what I look for, what you should be looking out for, and how you can be cashing 100 pips at once, 200 pips and 300 pips, and just 2 trades or 1 trade in a week you can get 300 pips. You don't need to trade 5 times, 10 times in 1 week. You can just come to this your chart and only 1 trade gives you 300 pips because I trade on a 4-hour time frame. The strategy can work on any time frame, but this is where I use it. Okay, it works on any time frame. I will show it to you how it works on other time frames as well. I will show it to you. So I have not really told you now the strategy per se, but these are the building blocks. Okay, you have to rewatch this over and over for you to understand what I have done in this video. And if you don't understand it, ask your questions. I will address them in the next class. Okay, all right, with this we've come to the end of this class. All right, see you in our next class.